Hello and welcome back to another week of your Mortgage Market Movers Weekly. Woo! Last week was a very big week with a probably the biggest thing that's happened in 2025 so far, the release of the tariffs. Quote unquote Liberation Day took place last week, and that has shaken up the market like crazy. So we're going to get into that in this episode. Just so you know, the 30-year fixed rate is sitting at an average of 6.64, which is down 1 basis point from last week's 6.65. We had good job information that came in this last week. However, I don't know if that was good enough to offset the Liberation Day news. Next week, we have some inflation data. We're going to go over all of that in this week's episode, so stay tuned and let's get over to the charts. Here we are, back over to the charts. We have our good friend, the US 10-year pulled up, and we also have the TLT overlined on this chart, and not overlined, but also on the chart. And of course, the US 10-year is the proxy for the 30-year fixed rate. The TLT is the bond market. So the rates took a nosedive down on Thursday and Friday. So really they've been all last week. If we look right here, this is, well, let's see. So Friday, they started coming down. Then Monday, Tuesday, Wednesday, Thursday, and Friday. Just down. Now, what happened to cause all of this was a severe drop in the stock market. So, good news is the rates came down, but bad news, don't look at your 401ks. If you have any stocks there, that 401k is probably not looking great. All right. Now, typically there is an inverse relationship between the stock market and the bond market. So with the stock market heading down, the bond market was heading up. When bond market heads up, then the 10-year yield heads down. It's not a perfect relationship, but we can think of the 10-year yield and the stock market having a negative correlation. Probably not a perfect -1 correlation, but for our purposes, it is good enough. The 10-year yield got all the way down to 3.862. And just so you have some frame of reference for the significance of that number, because like I said, this is not the 30-year fix, but it is a proxy. As the yield heads down, the 30-year fix is also going to head down. Typically, there is a spread between the 10-year yield and what the 30-year fixed rate is, and that spread is where investors make money, banks make money. It's typically about 1.5 to 2%. So the average for last week, the 30-year fix came down to 6.64, and we'll look at a chart in a second here to look at that. But it looks like the 30-year fix is coming down and rates are coming down significantly. So if you were looking to buy a home, it's definitely a better time. And, if you bought a home up here back sometime in January, where rates were significantly higher, I mean, we can see that the 10-year yield was the highest it's been in a fairly long time. So if you bought a house back here in January, then it might be a good time to refinance as the rates are coming down significantly. All right, so let's head on over to the economic calendar and see what was going on last week. Really what's important to us is, we see all this stuff, and some of it is going to be fairly important to the financial markets, but what's important for the real estate world is, we can look at this unemployment rate. These things are important as they impact the Fed's desire to cut, hold, or raise rates, not interest rates, but the federal funds reserve rate. And the unemployment rate, the economy, it's As far as unemployment goes, it's not getting crazy. So 4.2%, and this is a monthly number, up only 0.1% from last month's 4.1%. So really not doing anything crazy. Non-farm employment change looks at the change in the number of employed people during the previous month, excluding any farming. So it looks like 228,000. So that's a big change in employed people. So that's good. People are getting jobs. When you look at the jobless, the jobs listing, the JOLTS, when we talked about that the previous week, we saw that there were more job listings. So it looks like some people got those jobs. So good for them. Again, last week, it was Liberation Day, April 2nd. And, sorry about that. But Liberation Day was April 2nd. And unless you were living under a rock, right, you probably heard something about this. And the president came out and had a list of what the reciprocal, and we'll say quote unquote reciprocal, tariffs were going to be for a long laundry list of countries. Now, it's quote unquote, right? And this isn't too important. I guess it's just to give some context into why the stock market freaked out a bit. And the stock market freaking out helped the 10-year yield come down, which helps mortgage interest rates. But really what happened at the speech on April 2nd on Liberation Day was that reciprocal, and we'll use that word really loosely, tariffs came out, and what really happened was that they took the trade deficit divided by the trade surplus for any given country, and they got a percentage, and then they cut that percentage in half. So countries like China, where they have a 2.2% tariff on us, China was given a 34% tariff. And then to top it all off, China came back and said, well, we will really do a reciprocal tariff, which was 34%. So they went from a 2.2% tariff up to a 34% tariff. The market was not anticipating that at all. Most analysts were forecasting a 10 to 20% tariff on countries, with most leaning towards 10. So, when we see these crazy astronomically high numbers, some of it was 50% tariffs, I believe, on some countries. The market really didn't like that. So people were flocking to bonds, which brought the U.S. 10-year yield down. So that was the main event last week. This week, we have inflation data coming out. So we have core CPI month over month, non-core CPI month over month, and the year over year CPI. That is the consumer price index, and that is basically a bundle of goods, and it looks at the price increase from this either year or month and compare it to either last year or month. So we are looking at an expected increase of core CPI, and core just excludes any food or energy. So the increase is forecasted 0.3%. We're looking at the CPI year over year to be 2.6%. Previously, it was 2.8%. So if we got a 2.6%, that means that inflation is coming down, which is good. We have unemployment claims coming out Thursday, April 10th, and then PPI Friday, April 11th. And this is the producer price index. So when we do start to see tariffs come into play, which I believe April 9th is when all those tariffs are going into place, this PPI is going to be really important to look at, because this is going to be, from the producing side of things, what the inflation numbers are looking like. We also have sentiment. Consumer sentiment can shift the market. We've had fairly negative consumer sentiment lately, and inflation expectations. So it might not move the market too much. Things like this tend to get put in the shadow of these major events like the Liberation Day tariff events. All right, so that is this week coming up. We took a look already, but just to show you the chart. So rates have been coming down. In January, like I said, that was 7.04% was the average 30-year fixed. Came down to 6.63 March 6th. We saw a little uptick up to 6.67. Nothing crazy, I wouldn't stress about that. And it is coming back down. So last week, as of April 3rd, it was 6.64. I would imagine that this week's number will be lower. So really, yeah, that's what we got for you this week. If you are interested in purchasing a home, and like I said, the rates are definitely coming down. So if you want to refinance, if you bought back in January, want a lower rate, if you are looking at homes now, it might be a great time with interest rates coming down so much. So give us a call at 877-TEAM-MBL. Find us at mortgagesbylinda.com, and have a great week, everybody. Take care.